Welcome back to week 46. This is part 2. We're going to talk about valuing your business, how to do this. So this is going to be a very brief overview, and that's because it could be very complicated, and it usually is complicated, and should be performed by a professional. This is just to kind of give you an idea of what to expect. And in the next part, we're going to tell you about how you can, the things that you can work on that will improve your value, so that when that time comes, you can actually, you can get the best bang for your buck. So just to let you know, again, the true valuation could be a very long, drawn out process with many considerations that you're not really going to think about. So you shouldn't worry about. That's for the financial experts. So we're going to talk about discounted cash flows or the weighted average cost of capital. I spent an entire semester in my master's program valuing a business, and it was not an easy process. You can perform it for fun, or if you're selling to a family member, whatever. But if you don't want to pay someone, that's fine. But any type of real valuation should be done by a professional. The first place that you're going to look to work on your valuation is going to be in those 3 sheets. So we went over that in week 29. So assuming you're comfortable with that, go through and find any anomalies. You're going to want to explain those. So if debt like skyrocketed or sales tanked one year or whatever it was, you're going to want to be able to explain those away. And then create some projections for the next 3 to 5 years based upon solid assumptions. So this could follow trends of growth. This could follow, like anything really. You just want to make sure that your assumptions are solid when you're creating those projections. The big ones that you're going to want to really address are going to be your revenue, your expenses, assets, debt, cash flows. All of those like concrete numbers are the things that are going to be more easier to project than say some of the other stuff that's like when we talk about intangibles in the first section. You can't really, it's hard to put a value on that. Consider your customer base. So is the buyer going to be buying your book of business or your market share? How loyal are your customers to you? So are they loyal to you, the person, or your business? And you need to consider that, because if the customers leave when you leave, that will be considered by the buyer for sure. Getting into the intangibles, so we've got obvious ones like patents, copyrights, other intellectual property, contracts. You want to think about those, the brand, the risk of your industry. A lot of those things are going to go into that value, because if you are in a riskier industry, you might be less valuable, because people are going to pay money for the business, but they're going to want a discount because of the risk. Consider your place, your position post close. So if you're staying on in any fashion, that's going to get factored into the price. So for instance, if you stay on as an employee or an advisor, whatever it is, your salary is going to get factored into that cost. So just think about that as well. And then see if you can compare against any recent transactions. That stuff, especially with small businesses. The private businesses, it's a little harder to find, but it can be found. Talking to a lawyer or accountant or whoever, you might be able to find something that you can, kind of compare yourself against. And lastly, when we're talking about valuing your business, you want to talk about estimated profits. So this is the money that they're going to make post sale, again, for their return on investment for that, what the resale value is. So if you sell to them and you've got equipment that's worth $500,000 and you sell to them, what's that equipment going to be worth in a year, 5 years, et cetera? They're going to factor that in. And this could be as simple as the investment minus the risk. So again, assets, profits, intellectual property, debt. Your debt is going to go with it. In theory, your debt is going to go with the sale as well. So if they're buying your cash accounts, they're also buying your debt accounts, your liabilities. You want to think about how quickly they can recoup on their investment, and then kind of back to if there are any recent transactions, what are the industry standards? So if you're in the candle making industry and there's a lot of transactions in the candle industry, then you have something that you can base your value off of. But if not, then you're kind of winging it. But think maybe it's some other sort of production, some other sort of retail, whatever it is. Just see what those standards are, and possibly compare yourself against that. So that's it for week 46 on business valuation. And we have another one coming up where we're going to talk about the different ways that you can improve the value of your business.